Hello, everyone. A very warm welcome to our today's session on local proficiency in taxation of Sri Lanka. As you all know, we have the knowledge partner EY Sri Lanka with us, and a lot of trainers have joined in today for the corporate tax sessions. But I'll be handing over to Jivanti and Roshni for the session to be kicked off and introduce the rest of the trainers.
At EY, one tiny question like, is there a better way, may seem a drop in the ocean, but it causes a ripple effect that can spread out to the entire world. Every question we ask can build confidence in the capital markets, can help our clients grow, innovators accelerate, governments solve more complex challenges, and communities to thrive. All of these better questions on a huge scale create long-term value for our people, clients, and society that leads to sustainable, inclusive growth. Every better working answer ladders up to achieve our purpose of building a better working world. So, the question that you ask is the drop that starts the ripple.
Good evening, everyone. Welcome once again to another session on the tax landscape in Sri Lanka. So today we are going to look at income tax today and next Thursday as well. To do the session, I have with me a couple of members of our team. Firstly, I have Roshan Anselm. He's a senior manager in global compliance and reporting. He'll be ably assisted by Akila. She's also in the global compliance and reporting team as well. And I've already introduced Jivanti, and Bipash is also there helping today and on Thursday. So they will go through some of the key sort of provisions in the law, income tax law. Like in the past, please do ask questions from them. There will be breaks in between, so please take the opportunity to ask, and hopefully we'll be able to address some of the questions that you will need to be addressed. So over to you, Roshan and Akila. Roshan, you're on mute, I think.
Thanks, Roshni. Good evening, ladies and gentlemen. Welcome to this session on corporate taxation. In the interest of connectivity, I will switch off my camera so that the connection. Yes, as Roshni indicated, the topic given is so vast with limited time. So I will cover the main topics. So this session, in fact, is not a training. It's just it will highlight the current topics which are relevant to your businesses. So after this session, you should be able to talk to your management and discuss about the current topics, and also engage with your consultants on the most relevant topics which are currently relevant to your business, especially during this year and next few years. So we have divided this corporate tax into two sessions, day 1 and day 2. Day 1, we will look at the income side of this, how to compute assessable income, taxable income, and tax liability. And in the second session, we will look at some of the expenses, deductions, and some special relief that the law is offering. So let's look at the course content for today. We will quickly have a look at the structure of the Inland Revenue Act, the present law. Then we will start with identification of income and then move on to the determination of assessable income. There we will also briefly look at the importance of identifying source in Sri Lanka. Then we will move to the calculation of taxable income, and then we will also look at the income tax rates, the prevailing rates, the rate structure, and also some of the exemptions under Schedule 3. So let's move on to the first slide. The present Inland Revenue Act is 24 of 2017. It's a beautiful act. It contains 22 chapters, 203 sections, 6 schedules, and it's divided into 2 parts. Some people think that the Inland Revenue Act is all about computing the tax liability and paying the tax. No, it's not. It's much more than that. Like any other law, the tax law also has certain obligations at various places: obligation to pay, obligation to file return, obligation to maintain documents, and so on and so forth. So once you meet this obligation, the law guarantees you some rights called taxpayer rights. I think if you have watched Hollywood movies, if a person gets arrested in US, the first thing he will shout is, "I'm a taxpayer, man." But fortunately or unfortunately, we don't do that in Sri Lanka. So the taxpayer rights are very important, which we will look at it in the next session if we have time. So let's move on to the next slide. The identification of income. Before we move to the identification of income, we need to know why this identification is important, because there are different rules in determining the types of income, and there can be different rates applicable. Therefore, your income, we need to identify into several sources, which is laid down by the law. So we will look at what those nature of income or the sources of income categories are. Next slide, please. So before I get to these sources of income, I just want to tell you the journey that we are trying to embark from here. That is, we will look at this income, only the income side, expense side, we will cover it in the next session. From the income, we will move on to the assessable income. That is, accumulation of all this income will lead you to assessable income. Then from assessable income, we will also look at slight complications and technical matters. From there, we will move on to taxable income, and from taxable income, we will move on to the tax rates. So it's a step-by-step journey that we are going to embark on. So the identification of income, the Inland Revenue Act specifies the following sources of income: employment income, business income, investment income, and other income. Other income is a catch-all clause where if the income does not fall into any of these categories, it can still be taxed as a other source of income. Now, this order of these sources of income is important because first you determine whether it's employment income. If it is not employment income, you go to the next category, business income. So if it is not employment and business income, then you go to the third category, investment income, and so forth, and so on and so forth. So we will look at the business income in the next slide. Section 6 of the Inland Revenue Act specifies what are these business income. If you take a business, it can be a manufacturing or it can be a trading which involves goods, or it can be a service. These are the two broad categories, goods or service. So that's why it starts with service fee. If you are in the business, service fee is a business source. You can also have a consideration received in respect of trading stock, that you are selling some goods either manufactured or imported or bought locally. Then you have certain other categories, gains from realization and amounts derived effectively connected with the business. So this is, there are a few other categories, but we have highlighted only the main ones. So these are some of the sources of income which falls under business income. The business income also excludes certain items, not you have only two items exempt amounts which are specified under Schedule 3. So if there is an exemption, it will not come under any of these liable source of income. Then employment income also is not a business income. So before I move to the next slide, I would like to highlight some of the key terms. One is the definition of business, very important, please be attentive. This definition of business under the new law include past, present, or prospective business. Very beautiful. If you look at prospective, now let's say I'm about to start a business, but I'm incurring expenses. So these are the expenses which we called under the previous law pre-commencement of business. So before you commence the business, you incur, but you still can claim it. In the same way, the past, your business has ceased, but the expenses relates to your past business. It can lead to a loss, but still you can claim. So the definition of business under the new law, this prevailing law, is very wide, and it encompasses different varieties of expenses, even pre-commencement business. I would also like to touch upon this effectively connected to the business. That is one of the sources of income under the business income. One of the categories under the business source is amounts derived that are effectively connected to the business. That is, it does not look like a business, but it is effectively connected. For example, you can your business premises, part of it is unutilized, so you rent it out on a temporary basis. What you get is the rent income. You might think it's a investment income, but according to this provision, it can be linked to the business and it can be treated as a business income. The next slide would be taken up by Akila, but before I go to the next slide, I would like to include a polling question at this point, which deals with investment income. And Akila, after the end of the investment income slide, will give an answer to this slide. I hope you can see the question. Srivanti, is the question visible?
Guys, Roshan has shared a link in the chat box. You guys have to click it. It's a question and you have to submit your answer. As you can see in there's a link. You just have to click it. It will open up a website and it will collect your answer.
Okay.
Link is posted in the chat box.
Submitted your answer. Do type done in the chat box.
Okay. While we await the audience reply on that, are there any questions that I can take up at this moment?
Shan, we have a few questions. One question is asking why is realization of capital assets fall under business income?
It depends on if the capital asset is used in the business, then the realization would be classified as a business income. On the other hand, if the capital asset is classified as an investment asset, then the realization would fall as investment. So it depends.
And we have another question on exemptions given to the employment income. So we are not taking that question right now because the exemptions we will discuss later in the subsequent slides. And some people are saying like the both links are not working. I think links are not working on mobile. So all others are posting, they are saying they are done. That's all, Roshan. Those are the questions we have.
Okay, and I'll ask Akila to take over. At the end of the investment slide, Jeevanti, if you can just share the results of the poll, it will be useful.
Yeah, sure, I'll do.
Over to you, Akila.
Thank you, Roshan. G, can we go to the next slide? So thank you, Roshan, and everyone who answered the question to the polling question. Now, in this slide, we will be discussing on the investment income. Now, among many other investment income that are specified in the law, the investment income will include the ones that are listed on this slide: dividends, interests, rents, royalties, gains from the realization of capital assets and liabilities. Then we have gifts received by the person in respect of the investment. Now, what I wanted to highlight here is the fact that investment income for one company may not be an investment income to another company. For example, if you take a bank, now the bank, they actively deploy all their resources to earn interest income. So in that case, an interest income would not fall under investment income to a bank, but it would be a business income. So it's important to determine where the source of income falls under, because the method of taxing would vary. And also, similar to a business income, an investment income will exclude exempt amounts. We are going to discuss what these exempt amounts are in the coming slides. And also, whatever the income that we classify as a business income will be excluded here. And yes, the answer to the polling question, actually, Jeevanti, can we put the question on screen or? I don't see responses though. Can expenses be deducted from investment income in Sri Lanka? The answer is yes. Yes, you can deduct expenses that are directly attributable to the investment income. We are going to discuss expenses as explained by Roshan in detail in our day 2 session. Okay, can we go to the next slide, G? No, okay. Assessable income and determination of source in Sri Lanka. We are going to look at what an assessable income is and how do we determine a source in Sri Lanka, and what is the importance of a source in Sri Lanka. Yes, next slide. Now, an assessable income of a person for an year of assessment, it consists of income from each sources, which has to be calculated separately. Now, the sources were discussed earlier. The sources would be your business income, investment income, employment income, and other income. Now, a key term here is an year of assessment. So what is an year of assessment? An year of assessment would be a period of 12 months commencing from the 1st of April of any year, and it ends with 31st March of the immediately succeeding year. Now, in most of the Sri Lankan companies, the accounting year ends at 31st March. But if there are instances where your accounting period ends at 31st of December or any other, if that's the case, you have to make a written request or an application to the Department of Inland Revenue, and they will give you an approval, a written approval, to use a different accounting year, which is not 31st of March. So now, what is assessable income? In arriving at the assessable income, you have your sources of income, which are your business, investment, and employment. And then these income will go through certain changes. You have to do certain tax adjustments. There will be additions, deductions, and finally you arrive at this figure. So we will look at how to arrive at assessable income in the coming slides in detail. But what I wanted to highlight in this slide is the fact that the method of taxing would be different in the case of a resident and a non-resident. In the case of a resident, your assessable income from all of these sources of income would be taxed only in the case of a non-resident, only if that source is in Sri Lanka. But in the case of a resident, wherever the source of income arises, you will be taxed. Now, Roshan will be looking at what source of Sri Lanka is and how you determine the source of Sri Lanka. Over to you, Roshan.
Thanks, Akila. Right, now we started this process by looking at the sources of income, that is business, investment, and other. And we accumulated all these income sources to arrive at the assessable income. And there was certain exemption, which we will look at it later, that we were supposed to remove, exemption under Schedule 3. Now, when we try to attempt to come to calculate the assessable income, there is an additional complication. The law introduces something called source in Sri Lanka. And it says if you are a resident, you are liable wherever the source is. But if you are a non-resident, you are liable only if it has a source in Sri Lanka. So the source in Sri Lanka and source and foreign source. So we need to find out what constitutes a source in Sri Lanka, because in some instances, if it is not a source in Sri Lanka, the assessable income does not get captured for Sri Lankan taxation. So we are going to find out why is this source in Sri Lanka important. So like I said, there is a difference in taxation, because if it is source in Sri Lanka, whether it's source in Sri Lanka or not, a resident is captured on his full source, but a non-resident is captured only on source in Sri Lanka. So a non-resident person should know what is not source in Sri Lanka, so that it will not get taxed. Otherwise, source not in Sri Lanka also will get taxed. And the other important point is about this foreign tax credit. When you say foreign tax credit, it simply means your taxes which are paid outside Sri Lanka. For example, imagine you have a company in Sri Lanka which has some business operations in Maldives. So you will declare your tax to the Maldivian tax authorities and you will pay tax in Maldives. And because it's a resident company and you have a branch or whatever it is, so it's consolidated in Sri Lanka, and you will also have to declare it to the Sri Lankan authorities. So whatever taxes that is paid in Maldives outside Sri Lanka, you can take it as a credit when discharging your local liability. But you cannot just blindly deduct it. Out of the total profits, you have to compute the Sri Lankan tax liability that is attributable to your foreign operation. And from that, you can take a credit. So this source in Sri Lanka and foreign source is important for these two reasons. Among other reasons, they are important for two reasons: to calculate your appropriate foreign tax credit and also to calculate what is your liability. So we will go on in detail to find out what is this source in Sri Lanka. So section 72 and 73 defines what is the source in Sri Lanka. What is not source in Sri Lanka is a foreign source. So foreign source is defined to be anything other than source in Sri Lanka. So we need to find out what is source in Sri Lanka. So anything which is not source in Sri Lanka is a foreign source. So first of all, it says consideration received in respect of trading stocks, that is for sale of goods, where domestic asset or liability is involved. So if a domestic asset or liability is involved, it has a source in Sri Lanka. For example, if there is a manufacturer who is exporting or who is selling locally, it involves asset and liability domestic. So therefore, it has a source in Sri Lanka, so they are liable. Payment for employment. If you are employed, employment is exercised in Sri Lanka. So then it is a source in Sri Lanka and liable to tax. whether resident or non-resident. If a dividend is paid by a resident company, then it has a source in Sri Lanka. If it is rent paid, the asset, if it is situated in Sri Lanka, it has a source in Sri Lanka. Any services not identified separately, because this list is not exhaustive. It's like we have selected the key ones. So there are so many other specific, like transportation, telecom. So all those business sectors, the law says how the source in Sri Lanka is defined, which is liable. So there is a general clause which says, okay, if the services is not specified anywhere, then the criteria is the services should have been rendered in Sri Lanka. So if a service is rendered in Sri Lanka, then it has a source in Sri Lanka. Then the last one, not the last one, but I have highlighted because it's slightly different to the others. If it is interest, annuities, royalties, or a technical service fee or a similar payment, irrespective of the provision of services or where this arises, if it is paid by a resident person, it is source in Sri Lanka. So these are the rules regarding source in Sri Lanka. So why is it important is anything which does not fall within this will be considered foreign source, and the implications will be different for a resident and a non-resident. And even if you have foreign source, then you have to calculate your local source, taxable income and liability from local source and foreign source separately. Let's move on to the next slide, which is calculation of taxable income, which will be presented by Akila.
Thank you, Roshan. Now, based on the things that we've discussed throughout this session, here I'm going to explain the steps and the flow of calculating the taxable income of a person. Now for this, first we take the gains and profits from each source, that is employment, business, investment, and other. Now here it's important to identify what includes inside this gains and profits. Now in the case of a business, what we consider is the profit before tax, that is whatever the income of the business minus the expenses. So in accounting terms, it would be revenue less expenses. In the case of an investment, the profits and gains would be your investment income less any expenses that are directly attributable to earning such income. So we will be discussing the deductibility of expenses in detail on our day 2 session. Now the provision in the tax law of Sri Lanka, it requires us to arrive at the assessable income from each source separately. For this purpose, we need to make tax adjustments as required by the law, because we can't simply take the profit before tax figure in the accounts and apply the tax rate on it, because some expenses are not permitted to deduct as an expense in the law. So which means certain expenses that should be added back to the profits and gains, this would result in an increase of your taxable income. And there are certain expenses that can be deducted from your profit. So this will bring down your taxable income. So these adjustments are mainly for expenses. So for the purpose of explaining this, I would just make it general and say tax adjustments. So you do these tax adjustments, and on the other hand, if there are any exempt amounts, which will be discussed in a while, you remove that as well. So once those adjustments are done, you arrive at your assessable income. Now, what is in between the taxable income and the assessable income is another deductible expense, which is under Section 52 of the Inland Revenue Act, called qualifying payments. Here, you are allowed to deduct expenses. So, for an example, donations made to an approved charity, or donation made to a government, which are specified under that. You have to meet certain conditions under the particular section of the Act if all conditions are satisfied, you can deduct that as an expense as well. And finally, you arrive at your taxable income. Now, this is the income where you apply the tax rate applicable to your entity. So, Roshan will take you through the tax rates that are available for each sector and each entity. And also, he will take you through the different exemptions that are available for you to claim. Roshan, over to you.
Thanks, Akila. Let's look at the section on income tax rates. So what I will do is I will take you through the band structure, and then we will look at some of the individual business activities which qualifies for a lower rate. So under the prevailing law, we have a standard rate of 24%, which is applicable to companies and businesses. Then we have a concessionary rate of 14%, which is applicable to priority sectors, which is listed down, which I will look at it individually. We also have a separate rate of 18% introduced last year through an amendment law for manufacturing businesses. So if you are in the business of manufacturing, you have 18%. Then we have a higher rate for betting and gaming, liquor, or tobacco businesses, 40%. So there can be instances where you have these multiple rates which are applicable to businesses, where you have to prorate your business profits and apply different rates. So you need to be very careful. Either you can attribute it, I think the law requires that you, from this year onwards, that you prepare separate P&L for tax purposes, not for audit purposes, but for tax purposes, in order to identify these different rates. So this separate P&L is applicable if you have more than one rate or an exemption applicable. So the rationale behind that is the prorating will not give a real picture. So what the policymakers want is for you to prepare and identify the different profits applicable at different rates, so that you will pay the optimum tax. And if we can look at some of the sectors which have a concessionary rate, we have this small and medium enterprise, where you will qualify for a 14%. It was introduced a few years back, and the meaning of small and medium enterprise was subject to an amendment, where now they permit even group companies. If you have associates, you can still qualify for a small and medium enterprise and pay 14%, but the total turnover should be less than total turnover of the entire group of associates should be less than 500 million, and associate has a very broad definition. So if you are applying 14% and if you are part of a group, you need to be very, very careful in order to ascertain that you have identified all the associates, because the definition is very broad, that you have identified and you are quite sure that the total turnover is less than 500 million. That's small and medium enterprise. Then we will move on to the exports, a very popular concession. It has been there for many years, but this year in the last amendment, we saw a significant deviation from the definition, in the sense all this time it is export, where we had the traditional idea of where goods leave Sri Lanka. But this time the exemption does not talk about exports. It says sale of goods including exports. It says sale of goods including exports. So export is only a part of sale of goods. So if you are having a sale of goods where you get foreign currency and where the foreign currency is remitted to Sri Lanka through a bank in Sri Lanka, you are qualified as an exporter and you will be entitled to 14%. So the law does not say you have to physically export. So you can have so many interpretation, but the definition says sale of goods for foreign currency remitted to Sri Lanka. Then we have another interesting category which very often go unnoticed. This is not something new. This has always been there. but it's subject to certain changes. It's a specified undertaking where you have a list of services, which we will look at it in the next slide, mainly to do with shipping, logistics, and few other areas where they give concessionary rate. So that list, once we will go through this and we will look at it. Then we will have the tourism sector, which has always been there, and we have healthcare. Tourism is defined in the original law. Healthcare is undefined. Educational service is also there. Construction services is there. Construction also is not defined. Agro processing has a lower rate. We also have renewable energy, which is liable to 14%. Then we also have dividends now. Now, after this abolishing of the withholding tax, dividend becomes part of a taxable receipt. The recipient pays 14% tax on dividend. Earlier, it was the payer who pays withholding tax. Now, the recipient, if you receive dividends, you will pay 14% by including that in your assessable income. In dividends, I would also want to say there are export businesses where you have dividend income plus export proceeds. There are opportunities where you can reduce your rate of dividend tax from 14 to 7.5. So that would be absolute saving for you. So if there are businesses which have this setup where you have export turnover plus dividend income, then you really need to look at it, and you need to speak to your consultant, and you need to have a look at it. Now, moving from this, we will now have a look at the specified undertaking. I think it has about 12 or 13 items where there is a 14% tax concession given. Entrepot trade, this involves if you are sending some goods from second country to third country. No, goods will not come to Sri Lanka, but it will be shipped directly. Then you qualify at 14%. Or you can do minor processing and re-export without bringing the goods inside Sri Lanka, but at the port. Minor processing and export, it qualify for entrepot trade. Offshore business, where you can manufacture some goods outside Sri Lanka and export it, so profits will qualify for 14%. Then front-end services to clients abroad, like the back office, this is the opposite of back office, where you provide front-end services. Headquarters operation of leading buyers will qualify. Logistics services such as bonded warehouse or multi-country consultation, which will qualify for 14%. Transshipment operations, 14%. Freight forwarding, freight forwarders will qualify for 14%. Then we also have supply of services to, this is a very broad section, because what it says is, if you are providing a service to an exporter of goods or exporter of services, which are essentially related to the manufacture of the goods or the provision of services. For example, if there is a garment manufacturer and there is a subcontractor who does part of the manufacturing, part of the manufacture of garments. So that subcontractor will qualify for this. So you need to provide a service which is essential to their business operation, essential to the manufacture or the provision of service, then you will qualify. But there is a condition here where you have to where consideration will have to be received in foreign currency for income tax purposes. Then you have production or manufacture and supply to an exporter of non-traditional goods. You will qualify as 14%. This is where the indirect exporter comes. So it has to be production or manufacture, and then you supply to an exporter. You cannot buy and supply, either you have to produce or manufacture. So indirect exporters would come under this, but it has to be, the exporter has to be a non-traditional goods exporter, not the person who supply. Then we have this ship repair, ship breaking, refurbishment, provision of computer software, computer programs, and various other related ones. Then here also there is a foreign currency requirement. Sale of any gem or jewelry, 14%. Then this bunkering, which was introduced in the recent amendment in 2021 amendment, bunkering services is liable at 14%. Next slide, please. We will also look some of the other entities like partnerships, which are liable at 6%, charitable institution, and some funds and trust, which are liable at different rates, 14 and 18%. At this point, before we move to the next section, which is exemption, which is very important, I want you all to be very attentive because it can be very useful to your business. So before we go there, we would like to have a polling question like last time. So that question would be posted to you via the link. You have to click the link and you need to choose an option. It is about export proceeds. The question would be the time frame an exporter has to remit the export proceeds into Sri Lanka. Is it 1 month from the date of transaction, 3 months, or 6 months? The stipulated period, or whether there is no time frame. In the meantime, I will take, if there are any questions, I'll be happy to answer your questions before we go to the next section.
Yeah, we have one question that is bunkering. Any example? Do you have any examples to give, Roshan, for bunkering?
Yeah, bunkering is basically the sale of fuel to ships. That is these international shipping lines. They enter into long-term contracts. So if the prices are competitive, so how it is supplied is barges. So you buy the ship fuel, and there is something called barges where you go to the sea and you supply them. So it's basically supply of fuel to ships.
Jivanti, there was another question on residency, no?
Residency, yeah. How the residency and the non-residency decided? How you should decide the residency or the non-residency? That's another question, Roshan.
Basically, if a non-resident person, a foreign person, any person who comes to Sri Lanka and stays here for more than 183 days will become a resident. And that's for individual. For a company, any company incorporated in Sri Lanka is a resident company. Any company incorporated outside Sri Lanka doing business in Sri Lanka is a non-resident company. For example, if a Singapore company comes to Sri Lanka, sends its employees to Sri Lanka to do a consultancy, then it will retain the status of a non-resident because it has no registration in Sri Lanka. Right? So if a non-resident, such a person, if they earn income from Sri Lanka, what is earned, which has a source in Sri Lanka, will be taxable. So that's how you determine for a company. And there are complex rules. How do you establish that a company is registered? So you go into where the company is controlled from, where the board meetings are held, where is the management is located. So there are so many criteria as to decide, but generally, most commonly what we do is, if it is a company registered under the Companies Act in Sri Lanka, it's a resident company. Other companies who are not registered and registered outside Sri Lanka are foreign companies. Any other questions?
No, Roshan, that's all.
Okay. I would encourage you to ask questions. Any question is not a stupid question, so please feel free to ask anything. And are there any result on the polling, Jivanti?
Before that, Roshan, we have another question. If a
Yes.
foreign company has a subsidiary in Sri Lanka, is a subsidiary a resident company?
Yes, we have so many examples. So these multinational companies like Unilever, Nestle, and so many other multinational companies that we have seen. So it may be a foreign company. The moment it establishes a local subsidiary, that subsidiary is subject to registration from the register of company. Then it is considered a resident company. So 1 month, 3 months, 6 months. Okay, so majority seem to think that it's 6 months, and there are also who think 3. Right? Okay. The correct answer is the income tax law does not specify a time frame. It only requires that you have to remit the money, but there are other regulations which imposes time frame. For example, the Forex law has certain time frame to surrender proceeds, and the VAT Act also says in order to qualify as a zero rated person, you need to bring the money within 6 months. So the VAT law and the Forex law has a time frame, but the Inland Revenue Act does not have a time frame. So the most practical approach that one could take is when you declare that you are an exporter, probably when you file the return, at least at that point you should have brought the money, but there is no time frame. But if you have not brought it, then there could be consequences. The Inland Revenue can do an audit and they might dispute your 14% claim, but still then it will not be easy because there is no time frame under the Inland Revenue Act.
We have another question, Roshan. Can you explain more on what kind of educational institutions get 14% tax and which ones do not?
Please repeat the question, Jivanti.
Can you explain more on what kind of educational institution get 14% tax and which ones do not?
The law has not defined educational, so we have very little guidance. So if you can establish you are in there is no criteria laid down. So as long as you can prove that you are a school or a private tuition center or whatever it is, you are entitled to 14%. There is no criteria. I think VAT law had some criteria previously, government institution and so on and so forth. But this 14% does not specifically gives any guidelines unless if some guidance comes in the future. So as long as you are doing educational activities, you will qualify for 14%.
And also, I would like to add, like Roshan says, education per se is not defined in the income tax law. So generally, what happens if it's not defined, you have to go for the general meaning. So you have to see what education means. So like imparting knowledge. So if you are to apply a concessionary rate, you have to show that the institution actually is imparting knowledge to students, or or even mature students. So, and also maybe good if the institution is registered with the ministry, some form of formalization. If it's seen, the revenue authorities would take that as a more sort of a positive approach than having no registration. So the documentation has to be covered to be seen this particular institution is imparting knowledge. That's basically the general meaning of Otherwise, what we've seen is there are certain institutions which seem to be providing education, but it's actually doing more of a support service for education. So in that instance, we don't think the 14% rate will apply. Thanks, Roshan.
Thanks, Roshi. Since Roshi brought this topic, I am also reminded about this topic. We had the same issues coming up for contractors, construction contractors. So many queries whether what is construction contractors. So most of these people who are keen to come are like very remotely construction contractors. They are like installation. They do installation. They do various ancillary services. So in the absence of a definition, you get all these problems. So just want to share with you that.
We have another question on partnership. One question is, they're asking for partnerships. Is there any specific reason to tax at low rate tax, that is 6%? Roshini, shall I answer that question?
Yeah, go ahead.
I think there is no specific reason to tax at the lower rate at 6%. Anyway, earlier what happened was they want to earlier, like before January 1st, 2020, the provisions in the Revenue Act to not tax, like they are not taxing the they were not taxing the partnership, but the income was taxed at the hands of the partners. But after that, they proposed a 6%. I can't see any specific reason for that lower tax rate. Roshini.
Yeah, it's probably because they keep the intention is the partnership, the individual partners are liable for the tax. So what happens is the individual partners will get taxed at the individual income tax rates.
Yeah.
And these are taken as a credit. So the 6% was probably brought as a minimum tax, if I'm, yeah. So previously when this particular income tax law was introduced, the intention was not to tax the partnership. So there was no tax on the partnership. So it was only on the distribution that was getting taxed. And the individual partners were asked not only on their partnership income, if they had any other sources of income, you aggregate and then you discharge your tax and take credit. However, for some reason, there were practical issues in withholding. So what they did was they brought in a minimum tax. So that's probably the only thing that I can think of. There was no rationale given in terms of giving a 6%.
That's all good. Roshan, you can go ahead.
Yes. Now, to conclude this session, we would look at some of the exemptions which are identified in the third schedule to the Inland Revenue Act. As I informed in the beginning, the Inland Revenue Act has 6 schedules. So one schedule 1, stipulates the rates which are applicable to businesses, the rates that we just looked at. Then we have second schedule, and third schedule is what gives you the exemptions. So throughout the law, you will have reference to exempt items referred to in third schedule. So it has a long list of items, government departments, individuals, and various other things. But we have just looked at some of the industry specific exemptions that was introduced, mostly introduced in the last amendment, because you should be aware of this. So please be attentive, because if you have accidentally made you go to sleeping mode, please bear with us and please have your attention, because these are really useful to your businesses. So some of these are very useful. So we will quickly go through this. So agro farming, there is a 5-year exemption proposed from 1st April 2019. So agro farming is basically agriculture. So there can be complications where you have agriculture and then you also do the processing. For example, the tea industry, where they cultivate, and various other businesses where you cultivate and you process or you manufacture. So in such an instance, what they have provided is a mechanism based on market value of the agricultural produce to split your profits into agro farming, agro processing, and manufacturing. So agro farming will be exempted, whereas the other activities will be taxed based on the law. Manufacturing at 18% and whatever the agro processing for 14%. Information technology and enabled services, a very recent exemption, and it involves giving exemption for a variety, a whole range of IT-enabled services, from software development to system integration, various forms of IT-related services. But there are also conditions applicable. The condition is in the form of a minimum value addition for certain activities, and the number of local technical staff minimum for the firm. So we have seen so many IT-related companies making use of this exemption. So this is one of the move to make Sri Lanka a IT hub. So there is a gazette issued. So you need to be aware, if you are in information technology and if you meet certain value addition or minimum local employment requirement, you will get this information technology. So please engage with your consultants if you are interested. Then services rendered to any person to be utilized outside Sri Lanka. So this is similar to the exemption that we had in the previous law, section 13 D, where a person in Sri Lanka provides a service to another person, and the service has to be utilized outside Sri Lanka. Only providing the service to a person is not sufficient. You need to establish it is utilized outside Sri Lanka and you receive foreign currency receipts. Then you are exempted from income tax. So wherever there is a foreign currency, if you are in the service industry and if you happen to receive foreign currency inflows, you definitely need to screen all those to see if you meet these criteria. Like, then the other one is what we discussed under the source in Sri Lanka, foreign source where payment is received in foreign currency. So this is where you have a business operation outside Sri Lanka, where it doesn't have a source in Sri Lanka. Now, I just want to take you through the previous slide where we discussed, wherever, when I said if you are a resident person, you are liable to tax on taxable income wherever the source arises. So resident person, you are liable on the source in Sri Lanka and foreign source. But for foreign source, subject to certain criteria, it is exempted under section 3. So you don't have to actually pay tax, provided you meet those criteria, foreign currency inflows. So what is important is, even though it's captured within the framework of the Inland Revenue Act, you don't actually pay tax on that because they have given a specific exemption. Whereas a non-resident, that part will not even get captured under the framework of our tax law. That's the difference. Then we have boat or ship manufacturing. A resident person gets a 7 years tax exemption if you are in the business of boat or ship manufacturing. Then construction and installation of communication towers using local labor and raw material. So this is conditional upon local labor and raw material. So I don't know how far it is relevant. These criteria are practicable given the complicated nature of the communication industry. Then we also have letting bonded warehouses and related to offshore. That's for logistics services. Then we have the gem and jewelry cutting and polishing in Sri Lanka. These are some of the industry-specific exemptions that were introduced in the mostly in the previous law. Now let's look at some of the common exemption which has always been there. Again, on the sale of quoted shares has always been exempted. Then the interest earned by a charitable institution, and certain interest or discount, certain investments are made in government instruments like sovereign bonds and various. There is a list of investments where if you make an investment, then you are exempted. Then interest earned on foreign currency deposits, those there you have foreign currency account and you deposit the interest, there is an exemption. Dividend income received which is subject to dividend tax, that is where the final withholding has been paid, then there is a separate exemption that was awarded. Any amount derived by a person from the sale of any gem on which tax has been deducted. So those are the exemptions, which are key exemptions, but Schedule 3 has a long list of items, so we have not looked at all those things. As I mentioned at the beginning, our objective is to highlight the current areas which is relevant to your taxes, where you need to have a look at your tax computation to see whether you have considered these items. So that's our objective, not to highlight all the sections. So before I end this session, before we go to the final Q&A, I would like to summarize this. So this session where we started off is from the sources of income. We looked at business, what is business income, what is investment income, what are the components, dividends, interest, service fee, right? Then from those gains, then you arrive at the income. You deduct, and which these adjustments we will look at it in the next session. So you from the income turnover, you arrive at the profits by deducting expenses from these different sources. Then from income, from business investment, you arrive at assessable income, right? Total assessable income. You have an assessable income, you have different sources, and you have an assessable income. Then here there is a slight complication. Only if you are a resident, you need to determine all the assessable income wherever the source is, but you need to ascertain them separately. So if your total income is 1,000 and what has source in Sri Lanka is 300, you should be able to ascertain 300 is my source in Sri Lanka, 700 is my source in Sri Lanka, 300 is my source outside foreign source, right? So that is required by law, so that you can take the credit. But if you are a non-resident, you need to capture only the what has source in Sri Lanka. You need not bring and declare all your income from your country of residence. Then when you do these adjustments and leave out what has a foreign source, then you end up in the taxable income. Then in the taxable income, you apply the rates, and there are also certain exemptions which gives you relief. So with that, I would like to thank you, and that's the end of this session, and I'll be happy to take on any questions.
Roshan, we have a question. Wait, we have a few questions actually. Do these years of exemption mean you don't have to pay any taxes for a set number of years?
Yes, if it is a time-bound exemption, like I indicated 7 years, then you don't have to pay. But if there is no time-bound, then it goes on until the law gets amended.
There's another question. Does the software development companies categorize under the IT services?
Yes, it is, because software developed in Sri Lanka and even maintenance of software, it is categorized as IT enabled, but only thing you should meet the qualifying criteria where they say a certain percentage of the total technical staff, not total staff, total technical staff I think it's 50 or 70%, which so there is a gazette issued. So if you meet that criteria, has to be local staff, then you will fall under the exemption. You also need to be careful. Once you fall under that exemption, you also get a VAT exemption as well. But if you're exporting software, it doesn't matter. But most of the software companies, they use local labor, local engineers, software engineers. So you will fall. So you need to be, please engage with your consultant. And there is a gazette issued, which is called IT Enabled Services, which was issued last June or July 2021.
We have another question on foreign source. If the foreign country source is exempt, does this mean it is taxed in the foreign currency? If the foreign country source is exempt, does this mean it is taxed in the foreign currency?
No. Now, what I meant was, now supposing if you have a business operation in a foreign country, you will pay tax in that country, right? But when the money in foreign currency is remitted to Sri Lanka, there is a specific exemption for foreign source under the Sri Lankan law, right? Upon conditional that you will remit the money. So what happens is, Sri Lanka, that profits is exempt, whereas in the foreign country you have paid foreign income tax. For example, Singapore, you have paid tax to the Singapore authorities. So since the the foreign receipts are exempt, you will not be able to get any credit. But if you take an instance where due to this dollar crisis, if someone is unable to remit the foreign currency into Sri Lanka, which is conditional upon the exemption, then it will be liable to tax in Sri Lanka and you will be able to take the foreign tax credit.
Another question, Roshan. When does a non-resident company should register as a resident company in Sri Lanka for tax purposes?
Yes, that's a good question. So non-resident company doing a business in Sri Lanka, it's a vast topic, but let me try to summarize. It depends on various aspects. Whether the country has a treaty, then there can be criteria. So if a foreign country, basically a non-resident company doing business in Sri Lanka, can become liable to tax in Sri Lanka based on the country in which the company is resident, like I said, due to double tax treaty. So supposing, or if it is, there is a possibility it may not be liable. Let's say if it is a short duration, some consultant comes here, does some services, and the double tax treaty says that minimum number of days criteria is there, therefore is not liable. Company is not liable. Supposing if the non-resident person becomes liable, then he has to discharge the taxes in Sri Lanka. He has to obtain a tax registration from the Department of Inland Revenue. So it can be for income tax or it can be for VAT, right? So depending on the nature of services. But there is no requirement for him to register a company, but he can still be a non-resident person and can have a registration with the tax authorities.
Can I add something to what Roshan said? Now, after, I mean, if you are, no, I mean, if you have to pay taxes and you're not already registered, you have to register with the Inland Revenue not later than 30 days after the end of the basis period of that year. So the Act specifies that time period also.
Thanks, Akila.
Yeah, we have another question on agricultural income. Is it completely exempted for agricultural income?
Can you please repeat the question, Jeevan?
Yeah, the question is it completely exempted for agricultural income? the question he's asking whether the agricultural income is completely exempt.
Yeah, it says agro farming, and the law has a definition of what agro farming is. I think basically it's basically the agricultural activity where you toil your soil and where you produce crops, harvest, or rearing of fish. So it has a definition where it describes the activities that will fit into agro farming. So if you come under that, if you are only doing that activity, then your full profits will be exempted. But if you are doing that and doing something else, then you need to split your profits. So to answer your question, if your activity is only agriculture, agro farming, which is defined in the law, then your full profits will be exempted.
Basically, there can't be any processing, in short. No?
Correct. Yes.
We don't have any questions.
We can check the poll that was created by Bishop Vipash. Sorry.
Vipash, you posted another poll, or
No, Jivant, I didn't. No.
the question, Roshan? Does that mean Inland Revenue decides which non-resident company should register or not as a resident company? As I understood that there is no formal tax law.
No, it's not the Inland Revenue who decides. There are, under the Inland Revenue Act, there are criteria as to who would become liable. So first you need to apply the domestic law to that particular business to see whether under the domestic law, whether that person is liable or not. If under the domestic law, if the person becomes liable, then you apply the double tax treaty to check whether there is a relief given under the double tax treaty. So double tax treaty relief would depend on the particular country. So if there is a double tax treaty and if the double tax treaty gives a relief, even though he is liable under the domestic law, there is a relief under the double tax treaty, so he need not register. So by applying these two, still if he is liable to pay taxes, then he will have to obtain a registration. So the obligation is on him. The Commissioner General will not go behind him. He has an obligation to register and pay his taxes. And if there is no obligation, then there is no liability. If there is no liability, there is no obligation. That's basically is the rule. Any other questions, please? We have another 10 more minutes.
Till the participants write up their questions, one thing that I can do is, can you guys give some feedback about the sessions, the Sri Lankan tax sessions? Roshni is keen about the learnings that you're taking away from these sessions. So just write up your feedback in the chat box.
Firoz, if there is no questions, no further questions, shall we?
Yeah, just waiting up for some feedback.
Oh, okay.
Yeah, that's coming in. I thought Jivanti would be taking it out, but I can do that, no problem. Okay. Yapka is saying so much new things to learn about. Thank you for the session. Arif Islam, it's good learning experience. Irfan Ali, good to know about how tax works in neighboring countries. Great effort. Thank you so much, all. Uh, very easy to understand. So enjoyed and learned a lot. I would like to know what the status is webinar. Okay, Zara, I can take care of that in the WhatsApp group. Thank you for the great insights on the Sri Lankan tax system. Very similar to SA tax systems. South Africa. Okay. Very informative sessions. What I have available for the explanations. Okay, I noted, but it all depends upon the availability of the trainers and how they have designed the curriculum. But Roshni, I hope you did get the feedback from the participants.
Yes, which one? I looked at everything. Which one did you say about the availability of the trainer?
Sorry, I didn't get that.
Please touch on individual tax aspects. Okay. Yes.
Individual tax.
So like Firoz said, like we've had so many hours. So there is actually tax is a very sort of vast subject. So we are trying to put in, and as this is the first session, we've tried to bring in some of the key ones. So if there is another session, we'll try and introduce individual taxation as well.
That's right.
So yeah, so this time, Firoz, we are concentrating primarily on corporate income tax.
That's perfect, and you're doing a very good job. I would like to thank all the trainers who took time out today to deliver these sessions. Thank you to the participants as well for staying attentive and not losing focus, because tax is sometimes confusing and people lost interest. So I would like to thank the participants as well, and thank you so much, Roshni, for your time.
Thank you.
Thank you
Thank
so
you.
much, Roshan, for your time. Javanti, thank you for helping me out with the questions. Thank you, Vipash, for the polls, and thank you, Akila, for the insights. We will be meeting again on Thursday for the second part of the corporate income tax session.
Yes.
And if you have to say anything, Roshni, you can go ahead.
No, that's fine. Actually, you wrapped up perfectly. So we will continue from this on Thursday. Like Roshan said at the beginning, we will be specifically touching on deductibility of expenses, some special rules, and if time permits, we will also go through the compliance cycle as well. So that's what is planned for this week.
That's great.
So
Thank you
from all of us at EY, thank you and have a good evening.
Thank you so much. Bye-bye.
Bye. Thank you.
Thank you
Thank
very
you.
much, EY Sri Lanka. Thanks a lot.
Thank you. Bye.
Bye-bye.
Bye.